During the previous week, volatile conditions prevailed in the local currency market and the rupee touched a low of 73.49 and a high of 72.26 respectively. The rupee registered a high of 72.26 on Wednesday and threatened to test the 72.00 stiff resistance, but the intervention from RBI restricted the rupee's rise beyond the 72.25 level. The local forex market was extremely bullish on the rupee, placing their bets for its continuous appreciation on the back of huge forex fund inflows into the country. On Friday, the rupee started to weaken dramatically due to steep rise in US Treasury yields and concern on rising global inflation, and the rupee posted an overnight loss of 0.80% against the dollar. After more than 2 months of the domestic currency's bullish momentum, the rupee's depreciation can be viewed as a directional change in the trend. During the period from November 2020 till 25/2/2021, the market was extremely bullish on the rupee, and any intermediate weakness in the rupee exchange rate during the period remained unsustainable, and the market participants expected the rupee to appreciate, and their bet on the home currency proved to be correct. But the steep rise in US Treasury yields significantly weakened the rupee and established a new trading range between 72.75 to 73.80 till the end of March 2021. In the event of foreign fund outflows, which may arise in future at some point of time from the local market to the extent of USD 10 billion or so, the RBI has enough ammunition to sell forward dollars to the market from their forward dollar purchase book, and the swap market may have to buy and sell dollars at that point of time to make the spot remittance to the portfolio investors. The buy and sell operations in the swap market by the local banks would definitely bring down the forward dollar premium levels to around 3 to 3.5% per annum for 10 hours up to 12 months. Therefore, till such time the forex outflows hit the market or the swap market adjustments gets completed on the pay side positions, the forwards are expected to trade moderately higher. Potential inflation indicators are crude oil and 10-year US bond yields. In longer term downtrends, both have been mired, but both have rallied sharply of late. A multi-year breakout test has been played out yesterday for crude oil and bond yields at the same time. The breakout has almost materialized, and it would be a strong signal that inflation is real again. The market view maintains the inflation concern downplayed by Jerome Powell. Fed Chair Powell stated the higher bond yields are a statement of confidence about the recovery, and the Fed does not think inflation is about to accelerate beyond modest amounts. Powell's reassurance gave a fresh impetus to reflation trades and boosted the 10-year bond yield to hit a high of 1.61% on Thursday and ended at 1.45% on Friday. The gap between the 2-year yield and 10-year Treasury notes rose to 146 basis points at some point of time on Thursday, surpassing 136 basis points hit after Donald Trump's surprise election victory. Amid the global stock market havoc triggered through the rally in Treasury yields, the huge forex reserves of India combined with the forward dollar purchase position serve as the key buffer for any wild moves in the currency and stocks.